the Henry Ford paradox. This brings us to what economists call the Henry Ford paradox, a lesson from industrial history that's often overlooked in today's rush to automate. In 1914, Henry Ford doubled his workers' wages to $5 per day, a move that stunned the business world. The decision wasn't simply about generosity. Ford's factories faced crushing turnover rates, with some estimates putting annual attrition at nearly 370%. Workers left because the job was grueling and the pay was low. Ford's wage hike stabilized his workforce, but it also did something more important. It aligned productivity with purchasing power. By paying his employees enough to afford the cars they built, priced around $700 to $800 at the time, Ford turned workers into customers, creating a feedback loop that boosted both sales and loyalty. Brookings research highlights how this approach spurred demand and helped build the American middle class. The results were immediate. Ford's turnover rate dropped by about 70%, and the company saw a 48% jump in sales within a year. The policy became a model for how higher wages could drive economic growth, not just for Ford, but for the entire manufacturing sector. Ford's move also generated headlines and praise, with newspapers hailing it as a bold new standard for American industry. While there were strings attached, such as Ford's sociological department enforcing certain standards of living, the core idea was clear. Investing in workers could pay off by expanding the consumer base. Contrast that with today's automation strategies. Modern corporations often see labor as a cost to be minimized, not an asset to be cultivated. According to McKinsey, the average S&P 500 company now spends more than half its operating budget on labor reduction initiatives. Instead of building a loyal customer base from within, businesses cut jobs to boost short-term profits. Amazon's warehouse automation eliminated 32,000 positions last year. At the same time, Amazon reported slowing growth in Prime membership renewals, an indication that former employees, now out of work, are less likely to remain customers. This pattern repeats across industries. In the 1920s, manufacturing output soared while wages barely budged, setting the stage for the Great Depression as workers could no longer afford the goods they produced. Today, the gap between productivity and compensation has widened even further. Since 2000, productivity has grown 3.5 times faster than wages, echoing the same warning signs as a century ago. Automotive data makes the paradox visible. Tesla's Fremont factory produces 500,000 vehicles annually with 20% fewer workers than comparable Toyota plants. Yet, Tesla's U.S. sales growth slowed to 1.5% in 2024, while Toyota, which maintains more dealership jobs, saw higher growth. The jobs that Tesla cut were also potential customers for its financing and service divisions. In banking, AI-powered customer service at Bank of America handled millions of inquiries with thousands fewer staff, but internal research found that each lost job led to fewer loan applications, costing the company in future revenue. Retail and tech sectors face similar contradictions. Walmart's automation reduced labor costs by $1.2 billion last quarter, but same-store sales dipped almost immediately. Google's ad business depends on small enterprises, but as it automates sales and support roles, it erodes its own customer base. In food service, McDonald's saw profit margins rise after installing digital kiosks, only to watch same-store sales growth turn negative as former employees could no longer afford to eat there. Investment strategies often make matters worse. Private equity firms automate jobs, extract short-term profits, and move on before the decline in local spending catches up. National Association of Manufacturers data shows that firms replacing large portions of their workforce with automation report slower revenue growth than those that keep more people employed. Even in healthcare and education, automation cuts into the very populations that sustain demand, as job losses lead to fewer patients and fewer students able to afford services. As automation accelerates, the logic that once made Ford's factories thrive is being reversed. Instead of workers becoming customers, they're being sidelined. This shift has opened the door for a new kind of business model, one that doesn't depend on a broad base of consumers at all. The Freemium Economy. The Freemium Economy has become a defining feature of how businesses operate in the era of automation. Nowhere is this clearer than in the video game industry, which has quietly surpassed the combined revenues of the music, film, and television sectors. The core of this model is straightforward. Most users pay nothing, while a small group of whales spends disproportionately on in-game perks and upgrades. These whales typically don't rely on traditional paychecks. Instead, they benefit from income-producing assets, reflecting a broader economic shift where the value of labor declines and asset ownership becomes the main source of purchasing power. This approach is no longer confined to gaming. High-end brands and luxury services increasingly target the same kind of asset-rich clientele. For instance, Lamborghini sold more cars in the last decade than in the previous 60 years combined, a trend driven by buyers whose wealth comes from investments rather than wages. In retail, Amazon's data shows that Prime members in the top income brackets spend vastly more than typical subscribers, and companies like Walmart are expanding services that cater to affluent customers. Private jet fuel sales, for example, even as overall grocery sales stagnate. The focus shifts toward maximizing returns from a small, wealthy segment, while automation trims jobs that once supported broader consumer demand. The financial sector reveals a similar pattern. Goldman Sachs reports that the majority of deposits on its Marcus platform come from a small fraction of clients, primarily business owners and investors. Across banking, traditional wage earners now make up a shrinking share of assets under management. Banks invest more in automated trading systems and digital platforms, serving clients who generate revenue through capital rather than labor. This shift in priorities leaves fewer resources devoted to services aimed at the broader public. Hospitality and healthcare are not immune. Luxury hotel chains like Four Seasons report record occupancy rates, with a small percentage of guests generating most of the revenue. These guests, often CEOs or asset managers, expect and receive automated, high-end services. Meanwhile, budget hotels and community hospitals struggle, cutting staff and closing departments as their customer base erodes. In healthcare, elite executive programs expand while hospitals serving wage earners face layoffs and closures. The system increasingly orients itself around those who hold capital, not those who work for wages.